Most investors think their portfolio as having one risk level: conservative, balanced, or aggressive. But after reviewing hundreds of portfolios, I can tell you that most people don't have a risk level problem, they have a risk mismatch problem. In this video, I'm going to show you the 5 types of equity risk that quietly determine how your portfolio actually behaves and how to tell if the risk you're taking makes sense for the size of your portfolio. And here's a key idea I want you to remember throughout this video. You can be comfortable with risk and still be taking the wrong type of equity risk for the size of your portfolio. This is one of the most expensive mistakes I see confident investors make, especially as their portfolios grow past a few $100,000 or they're near retirement with a 7-figure portfolio on their own. For context, I've spent the last decade in personal finance and financial education, teaching people how to invest and how to think about risk tolerance. And one thing I want to be very clear about: risk tolerance should always be respected. People's comfort level with volatility matters. Here's what I've seen over and over again after reviewing hundreds of portfolios over the years. A lot of investors were placed into so-called low risk or balanced portfolios, not because they were thoughtfully designed for their goals, because no one ever properly educated them. And the unintended consequences of that, especially in a long, low interest rate environment with poor advice, is that many of these low-risk portfolios barely grew or even lost money over decades. And that raises a very uncomfortable question. If a portfolio doesn't keep up with inflation, taxes, or long-term goals, how is that actually low risk? Now, over the last couple of years, managing money directly, one thing has become crystal clear. Within asset classes, whether equities or fixed income, not all products are created equal. It's not enough to say, here's a global bond ETF or here's a low-cost equity fund and call it a day. And that's exactly the limitation of building a portfolio solely based on risk tolerance. True investors could be comfortable with moderate risk, but the investments selected within equities and fixed income can behave very differently, creating very different outcomes over time. That's why simply relying on risk tolerance alone often leaves portfolios misaligned with goals, even when the investor is comfortable with the level of risk. Portfolio design matters, and the specific investments you choose within each asset class determine how your portfolio actually behaves, how it grows, how it handles volatility, and whether it aligns with your financial goals. Otherwise, portfolios end up misaligned, underperforming, or exposing investors to risks they didn't even intend to take. Now, I want to talk about what equity risk actually is. Most investors think of equities as one thing: stocks go up, stocks go down. That's risk. But the reality is not all equities are created equal. With your equity sleeve, different types of investments carry very different risk and return characteristics, and they behave differently depending on the size of your portfolio. It's all about risk-adjusted return. How much risk are you exposing yourself to for the potential returns you are expecting? Let me break this down into the 5 flavors of equity risk. Number 1, high growth but highly volatile. These are the big tech innovators or emerging companies. Think Shopify, Tesla, Nvidia, or ETFs like Invesco QQQ or ARK Innovation ETF. They can deliver massive upside, but they swing wildly. If you're overexposed, a single market shock can wipe out years of gains. Number 2, concentration in a few stocks or sectors. Sometimes investors put too much into one sector or a handful of stocks. That could be a tech-heavy, like a FANG-focused ETF, FANG as in Facebook, Apple, Amazon, Netflix, Google. Concentration amplifies risk. If that sector stumbles, the portfolio suffers disproportionately. Number 3, you have broadly diversified equity funds like VCN or XIC, global options like XWD. These spread exposure across hundreds or even thousands of companies and sectors. Now, that diversification reduces single stock and single sector risk, making returns more consistent over time, even though the portfolio will still experience market level volatility. Number 4, income-oriented with capped upside. Some equities focus on generating steady income rather than maximum growth. So think Harvest Diversified Income Fund, which is a covered call ETF strategy, or Purpose Premium Yield Fund, which is a protective put strategy. They both generate above average dividend income. These are equity ETFs focused on high income generation by selling call option or put option contracts. They provide some downside protection in the stock market. However, in a bull market, upside is limited. which is fine if your goal is stability, some portfolio protection, but you need to recognize the trade-off and not just focus on it's a really high dividend. Number 5, low volatility funds. Finally, these are investments that are designed to reduce swings altogether. So low volatility ETFs like XMU, growth is slower, less large swings in the stock market, smoother returns, and contain companies that have historically done better than overall markets during downturns, but still capturing gains in rising markets. So the point is your portfolio isn't just conservative, balanced, or aggressive. The specific investments you select within equities determine how it actually behaves. If you stick with a cookie cutter allocation without considering these differences, you could be taking too much risk, or worse, not enough risk to meet your goals. And I've seen this over and over again. I see a lot of overlapping of ETFs and stocks within one's portfolio. So even though they have lots of investments, it does not mean they are actually diversified. And this is exactly why when I review portfolios, I don't just look at what you own, I look at how your equity risk actually behaves. If you want a second opinion or whether the equity risk in your portfolio still makes sense for where you're at today, you can book a free portfolio audit using the first link in the description. Here's a problem when investors stay on autopilot and don't pay attention to the type of equity risk they're taking. A 40% drawdown on a $100,000 portfolio, that's $40,000. It's painful, but generally manageable. You can stay invested, ride it out, dollar cost average, and recover over time. However, a 40% drawdown on a $1 million portfolio, that's $400,000. Psychologically, it's a very different experience. It can feel like losing half the value of your house or decades of work. Even if you're comfortable with equities and have a long-term horizon, the stakes feel much higher and it's harder to make rational decisions under that stress. The key takeaway: same risk tolerance doesn't mean the same equity allocation works. Larger portfolios require more careful construction to manage drawdowns, protect compounding, and stay aligned with goals. Otherwise, the psychological impact alone can lead to costly mistakes. I had a client who came to me with a $2 million portfolio. 30% of their portfolio was in a single stock, which is understandable since he was issued stocks by the company he worked for almost 20 years. My clients knew they wanted income from their portfolio, so they chose individual stocks based on the dividend yield alone. And suffice to say, a lot of the stocks were not good performers. Just because a stock has a high dividend does not mean it's reliable or even an overall good stock to own. So my clients had huge concentration in one single company, individual stocks based on dividend yield alone. Many of the stocks were not good performers at all. No asset placement strategy. Stocks were just placed all over the place across their accounts in their RSPs, TFSAs, and non-reg, so not very tax efficient. Remember, Canadian dividends are taxed better than US dividends. So if you're going to pay taxes on your dividends, it might as well be Canadian dividends. While both of them will be receiving pensions, can clearly tolerate higher risk levels based on the portfolios they own, this overall portfolio was still too risky for them. It wasn't diversified enough, and there are other ways to generate income without being overly exposed to the stock market. For example, purpose premium yield, structured notes that can pay 7% per year with some exposure to the stock market, but with downside protection, which is called a barrier. These are examples of investments that generate income that have downside protection when it comes to exposure to the stock market. And actually, structured notes are classified as a fixed income product in my realm. But I'll get into that in another video when I talk about not all fixed income products are created equal. I want to be clear, high growth equities are not bad. The issue is that at this portfolio size, the job of equities changes. It's no longer just about maximizing outside. It's about reducing deep drawdowns, smoothing the path of returns, protecting compounding, diversifying how income is generated. When equity risk doesn't evolve, the portfolio becomes inefficient. And what happens if nothing changes? If this goes unaddressed, a few things tend to happen. First, drawdowns become larger and harder to recover from, especially for those nearing or in retirement, even in normal market cycles. Ask anyone who was nearing retirement in 2008. Second, investors start making structural mistakes like selling at the wrong time or overcorrecting after volatility. The portfolio starts working against lifestyle goals instead of supporting them. Not because the investor did anything wrong, but because the equity risk was never redesigned for the size of their portfolio. Investors can both say they're comfortable with equity risk and experience completely different outcomes. One may experience large swings, long recovery periods, high concentration risk. The other may experience smoother returns, controlled downside, more consistent compounding. Same asset class, different design. And as portfolios grow, the cost of getting equity risk wrong increases. Taxes amplify mistakes, time becomes more valuable, and volatility starts affecting decisions around when someone can retire, worrying about whether the portfolio is enough throughout the retirement, and lifestyle choices. So here's the one thing I want you to take away from this video. You can be comfortable with risk and still be taking the wrong kind of equity risk for the size of your portfolio. And if you're not sure whether your equity exposure has evolved with your wealth, that's exactly what a second opinion is for. You can book a free portfolio audit through the first link in the description. Like and subscribe if you found this helpful. I'll see you in the next one.